Hello everyone. If you want to trade options, for sure you need to learn about option Greeks. So let's see what they are in 5 minutes. I'm sure that if you try to trade options, you've seen an option chain. Here we have a similar one to the one you would see in your brokerage. And as you can see, other than the strike price, the bid and ask, we have these Greeks. The Greeks are delta, gamma, theta, vega, and rho. Every option trader is checking the Greeks before entering an option trade because they're going to give you an idea of the sensitivity of your option price based on different market factors. So let's start with delta. Delta tells you how much the option moves in value based on the move of the stock. So for every $1 that the stock moves, your option price changes by that delta amount. So for example, if you buy a call option and the delta is 0.50 at $100 stock price, if the stock moves to 101, your option has gained 50 cents. So if you look at the graph, you have the option price change here and stock price change. You've seen if the stock price goes up, the option price goes up because the delta moves upward. Then you have gamma. Gamma measures how fast delta changes. So if the rate of change is high, it means that the delta will gain value faster. For example, if you have a delta at 0.50, a gamma 0.05, the stock rises $1, the new delta is 0.55 because we added the gamma 0.05. It's linked to the delta. When you talk about options, the big and important theme that always comes up is the time decay. And that's what theta measures. So think of theta like a leaking bottle. Your option value drips away every single day, even if nothing else changes. So even if the stock doesn't move, still you're losing value on your option just because time passes. So for example, if your call option has a theta of minus 0.05, and every time we talk about theta is with a minus in front because we're talking about time decay, every day you lose 0.05. Every 10 days, you need to think that minus 0.50 is gone without even the stock moving of the option doing nothing. It just with time decay. You can see that the value decays over time. And it's really important, for example, when we buy options to buy enough time because the theta is going to erode the value of our options. And it will start eroding the value very, very quickly after 15 days since you open the trade. Then it really erodes very fast the value of your options. Remember, obviously, if the time is an enemy for option buyers, is a friend to option sellers. Vega instead measures the volatility. So you need to think about chaos, uncertainty. When the volatility increases, the option prices go up. So if there are like big news, earnings, an event, moving towards these events will increase the volatility. So the Vega will increase and the options will be more expensive. So for example, if you look at your option Vega is 10 cents, the volatility goes from 20% to 21%, so 1% up, your option will gain 10 cents. Now, Rho measures the sensitivity to interest rates, which is not really important. It's part of this 5-minute course, but you don't really need to worry about it unless you are trading long-term options like 6 months, a year, they're called the leaps, then that Rho can be impactful, but we don't really worry about it. So just to recap, we have our delta, which is the option price sensitivity to the stock movement. Your gamma, the rate of change of delta, the theta is the time decay, and the Vega is the volatility sensitivity. Always check the Greeks before entering a trade. If you master your Greeks, you're going to master your trade.